Hi, good afternoon, everyone, and welcome to the first webinar by Glide Invest. We are really excited to kickstart this series of events for our viewers and customers across the globe. My name is Jaideep Tibrewala, and I'm the head of product here at Glide Invest, where I'm playing a leading role in building a great team that is building a platform that will simplify investing for everyone. The agenda for our webinar is very simple. We will start with a short presentation on how to invest for tax efficiency. We will follow the same with a panel discussion, and finally have a short session on how you should think about or what you should think about after you have taken care of your taxes. So without further ado, let me introduce you to Sumana Datta, who is the Assistant Vice President and Head of Financial Wellness at DSP Investment Management Private Limited. Sumana is responsible for driving the financial wellness program under investment education initiatives of DSP. As part of this, she works closely with the HR fraternity of over 100 corporates and institutes across India to help them structure and deliver financial wellness sessions for their employees. She also does these sessions for students, entrepreneurs, and professionals. Sumana has 14 plus years of work experience across banking, NBFCs, and asset management companies, and has served roles across multiple functions: sales, new business development, marketing, and training. Prior to joining DSP, she has worked with Standard Chartered, Religare Macquarie, and Goldman Sachs. She has a management degree in marketing from the University of Pune and is also a certified trainer from the Dale Carnegie Training Institute of India. Over to you, Sumana, for taking the session ahead.
Thank you. I'll share the presentation in a while. Hi, everyone, and thank you so much for joining us in today's session, which is all about managing our taxes most efficiently. I'm also going to be sharing a small presentation that I've made for this event. Just allow me a few moments. So the topic of the presentation today is X the tax. While of course, we're going to be discussing a few things about managing our taxes efficiently. That definitely does not mean delaying filing your taxes or delaying your tax saving investments, and of course not definitely evading taxes. So it's all about how do we recognize what kind of financial instruments are available to us for tax savings. So let's begin first by understanding what kind of income comes under tax consideration. So if you are a working professional, your salary, if you are having your own business or you are a professional, your income from business or your professions, even the money that you are investing in equity or fixed income markets, all of these income come under tax consideration. Also, if you have any income from your property, for instance, if you're renting it out, or if you have some income from other sources like dividends that you're earning from your investments or any kind of monetary gifts over 50,000 that you have gained for that particular year, all of these comes under tax purview and you're supposed to pay taxes under this. However, income tax department, with a view to encourage savings and investments amongst the taxpayers, also provide us with certain provisions and deductions from our taxable income. So let's quickly look at some of the popular instruments under Section 80C that are available for us. Now, these financial instruments could be the traditional ones, like you have PPF or bank fixed deposits or your national savings certificate or Sukanya Samriddhi Yojana. And of course, you have the new age instruments like an NPS or ELSS. Let's quickly understand some of these financial instruments that we generally use to do our tax saving investments. So as you all know, under Section 80C, we have the provision of investing 1,50,000, and till that amount, we can get these kind of concessions if we are doing investing into these financial instruments. Now, we all know what PPF is. Most of us would prefer this because it is one of the the oldest, and we consider it to be a stable instrument. However, we need to know also that we have a lock-in period of around 15 years for this particular product, and it has a partial withdrawal facility after 7 years. Similarly, many of us also prefer investing in bank provided fixed deposits. But what we tend to forget that when you are investing in a bank provided fixed deposits, you have a lock-in period of 5 years, and there is an interim tax that gets deducted from the interest that gets accrued even before you take it out. So many of these instruments that we consider to be the traditional ones and the preferred ones, they may have certain reservations that you need to know, and you need to find out by talking to your financial advisor whether that fits to your overall investing scheme. Just like these traditional investments, we also have some new age investments. We all know that beyond ATC as well, if we invest another 50,000 in financial instruments like NPS, we get some additional advantage. I'm not too sure how many of you know about this very popular and in fact one of the really distinguished investment possibility called ELSS, or equity linked savings scheme. ELSS, or equity linked savings scheme, is an open-ended equity mutual fund, rather a diversified equity mutual fund. It actually gives you the dual benefit. On one hand, while you are saving your taxes, it also has the potential of wealth creation. Now that we talk about wealth creation while we save taxes, is that even possible? Before that, let me tell you about a very interesting formula called the rule of 72 in personal finance, which many of us, financial advisors like us, talk about it. The rule simply says that if you divide 72 with the total returns that you are expecting from the financial instrument that you are investing in, you get to know, you have an idea of how long it is going to take for your money to double. It simply means, are you watching out on the rate of interest or the rate of return that you are getting from your financial instrument while you are saving taxes? Think about it. 1,50,000 is a big amount. And while you are investing it, it should also allow you the possibility of generating wealth because you're locking the money for a longer period of time. Besides that, also find out whether the financial instrument which you are considering for tax saving, is it helping you to beat inflation? So if you look at the present inflation rates, it's around 5%. If a financial instrument gives you a return of say around 6%, your actual return is really less. So really, it's very important to check whether you are beating inflation. So if you are considering the kind of returns that you're getting from these financial instruments, and also the fact that these financial instruments should be able to beat inflation, you are on the right path of creating wealth as well when you are taxing your tax. Let's quickly look at what kind of returns these financial instruments have given over the last 5-6 years. Clearly, you can see a choice like a ELSS fund or an NPS gives you much better return prospects compared to the traditional ones. Also, in addition to the kind of returns that ELSS fund has given, because it helps you invest in the equity market, it has a lock-in period of only 3 years. The best way of investing in ELSS fund, which is again open-ended diversified equity mutual fund, is to go through an SIP route, and you can start with as low as rupees 500. Though there is no upper limit cap, but from the point of view of tax saving, the limitation is still 1,50,000. But you can continue investing in these kind of funds for over 3 years, because in addition to tax saving, it also helps you with better prospects of returns because of the power of compounding. So friends, just don't consider the traditional ones, rather have a good combination of a traditional instrument and maybe a modern instrument like ELSS to get the best out of your overall returns from your tax saving instruments. So these are some of the tips that I thought I would share with you. Last but not the least, do remember that the money that you are investing. So far we were talking about taxes which are which are which are on the income that you're earning. But think about it, the money that you are investing, whether in the equity market or in the fixed income market, even that's also taxable, and there are certain rules. So for instance, if you are considering investing in equity market, and if you are sticking to your your overall investments, you're not taking out your profits before 1 year, and if your overall profit is less than 1 lakh, even after 1 year, you don't pay any taxes on equity. So similarly, many of you ask, what is the tax treatment for ELSS or equity linked savings scheme? It follows equity taxation. Since you're going to be taking out returns after 3 years, you are falling under long-term capital gains structure. And if your total return is less than 1 lakh for that particular year, you're practically not paying any taxes on your return. You're completely getting tax-free returns. So remember this as well when you are investing. When you're looking at investing in various options of tax-saving instruments. So that's it. That's about it from my end, which I thought to take you through it. So over to you, Jaideep, for our next conversation. Thank you.
Okay. Okay. Thank you, Sumana, for that. It's very interesting. And even after investing for so many years, I've learned something new today. So great. Thanks so much. So next off, let's carry the same topic into our panel discussion. But before we start our panel discussion, I'd like to introduce Mr. Prashant Joshi, who's the Chief of Products at Motilal Oswal Asset Management Company. Prashant is a chartered accountant and has about 21 years of experience in products, research, and wealth management. Prior to joining Motilal Oswal Asset Management, he has earlier worked with Tata Asset Management, Primerica Asset Management, Principal Asset Management, IDBI Capital, and Birla Sun Life Distribution. We're excited to have you on our panel today and hope we can all learn something new from your perspectives too.
My pleasure.
Let's get the panel set up and then we can get started. Okay. Sumana and Prashant, once again, thank you so much for taking out the time for our webinar today. Okay. Picking off from where Sumana left off in her presentation, let me present a couple of questions to both of you here. First, what are the different ways of saving taxes under ATC deduction? I think Sumana, you already picked on some of them. Prashant, maybe would you like to start off here?
Yeah, so it's quite a long list in the sense that it allows your investment at NSC, PPF, even your EPFO deduction, principal payment on a housing loan, even some expenses you can claim as a deduction under that. But basically you have to choose. There is no dearth of choice there. You have to choose. So you can choose ULIPs, PPF, ELSS. There is no dearth of choices what you can claim as deduction there. So you have two expenses. Rest of them are mostly investments.
Sumana, anything else you would like to add?
I just want to add one simple point here that most of us, we often tend to delay our tax saving investments, and we kind of keep it for the end of the financial year. And in such a rush, we forget that this entire piece of investment should also be a part of our overall financial planning. And we should also consider doing a risk profiling for even this bit of investment. So rather than waiting for the last 3 months, do it as a part of your overall financial planning at the beginning of the financial year and choose the one which is in your best interest. That's my bit to add, Jaideep.
Great, thanks. And picking up from what you just asked, typically, when we do our tax filing, employers or tax forms often talk about tax saving mutual funds. What are tax saving mutual funds? I mean, I know what ELSS is, but what kind of funds fit into this, or is it just about ELSS funds?
It is about ELSS. It's another way to put across ELSS scheme. Again, ELSS scheme, nothing but your regular equity schemes. It is an added component of tax benefit under ATC. And along with that benefit comes with a rider of a 3-year lock-in. So you can't redeem money for 3 years, and that's the minimum lock-in for allowed investments under ATC. And besides that, there is an inherent advantage in the sense that Because of the 3-year lock-in, the fund manager knows that his money is there, this money is for 3 years, and he can invest accordingly for long term. So besides that, more or less like your regular equity schemes with a tax benefit and a 3-year lock-in.
So taking on this question, on this point of 3-year lock-in, right? Can you explain, Sumana, how this 3-year lock-in works, especially for SIP investors? Because I think a lot of people don't understand that, what that 3-year term means and for which SIP amount. So can you help us here?
Yes. So each installment of your SIP is locked for 3 years. That's the definition of 3-year lock-in. So don't think that you've started, say, on January 2021, your entire corpus is going to, even the last installment, is locked for 3 years. So that's how we consider each installment of your SIP is locked for 3 years. And in the case of lump sum, of course, the entire money, that definition is actually easier to consider.
So if I'm an investor and I start in April of a particular year, so just give me an illustration, just give our viewers an illustration of how it would work. And when is it that I would be able to get out or exit an ELSS fund if I start in April as a SIP?
So if you start in April 2021, 22, 23, 24. So April 2024 is when your first SIP installment is actually getting free. Similarly, like I said, for each, so if you run, say, for 1 year, if you run that SIP for 1 year, and considering March 2022 would be the last installment of SIP, right? So 23, 24, 25, 2025 is when the last SIP, gets free and you can take out your money. Prashant, please, add, if I'm correct.
That's true. So it's for every money which goes in, from the time it goes in, it's a 3-year lock-in. So let's say at the end of, let's say you do a 3-year SIP, the last SIP, that the 36-month slip again will be locked in for 3 years time.
Okay, great. So Prashant, taking this next question to you. Should I invest in ELSS funds now that the market is down? Should I wait for the market to come up? What is your take? When is the right time for investors to think about investing in ELSS funds?
See, again, there are 2 points to it. When you're talking specifically ELSS, it should not be a year-end thing. As I said, it should be a SIP kind of a structure. You start on a monthly basis from the start of the year itself. And there is no right and wrong time. So if you are investing for 3-year horizon through SIPs, there is no right or wrong time in investing. And again, even if you specifically talk about current market times, we are not any overvalued too much by even long-term standards. I think it's a good enough time to get into ELSS. If you continue investing for 3 years time frame, see what we have seen over last 20 odd years. If you invest in ELSS scheme, not just for a 3-year horizon, if you pick up a standard, 5-year or 7-year term, even it has a 7-year term, it's an attractive investment. It beats all the other investment options net of tax with a reasonable probability of almost 80-90% probability. So don't think of it in 3-year term frames. If you're investing for 7 years, any time is a good time to invest in equity, especially if you're doing through monthly allocations.
And I think one important thing that investors also need to keep in mind is that, invest via an ELSS, there is a certain discipline towards investing that also comes in, which is a very important aspect of long-term investing. I think a lot of people kind of tend to miss that aspect out. Don't you think? Sumana? Sumana, any thoughts on that?
Absolutely. I completely agree to what Prashant had said. Just to second his thoughts, I just have one line to add. What's most important is the time that you're spending in any financial market and not timing the market. And that holds true even for investments like ELSS, because like I said, it's a part of your overall financial planning process, and you're investing in equity market. And good principle of investment says that, you should not be timing the market at any point in time. Rather, think about how long you can stay invested and benefit from the power of compounding. That's what my bit, Jerry.
So a question that we have gotten many times before from our young investors or our early investors, right, is should we start with ELSS with our first pay? How do we decide what is the right investment product to start off with, especially when we start our career, when we start a professional career, business career? And when is the right time to then pick an ELSS fund? Or is this always the best thing to pick?
See, if you look at it in terms of savings and investments and how global studies have been, see, the one thing which comes across is that it's not about how much returns you get on your portfolio. Traditional investors can look at reasonable as per their asset allocation. There is a return band. What matters most, or what determines whether you are better off 10, 15 years, 20 years down the line, is how much you invest. That is one part. How much you put in, that determines whether you have a satisfactory investment experience more than the returns. That is one major conclusion. Second is starting early. The power of compounding works magically if you start early. Looking back, if anyone starts earning, why not? From first month check itself, the savings has to go. And third point is being that whether when you're choosing which scheme to, or which asset allocation, or which option to choose for saving. The thing is, if you are young, you can take risk. You get better off. Even if you learn, if you have a better experience, you get off lightly. Idea is to take more risk initially, and as you have more corpus, more money which is at risk, you reduce your risk. At that time, start with ELSS. Why not? You have more time at hand. Even if market goes down over a long period of time, it will outbeat most of your alternate investment options. So these three things, why not? It should start from first month itself.
Okay, thank you. Sumana, question to you. Popular choice may not always be the best. What differentiates one ELSS fund from another? Any thoughts on that?
Okay, so I think most of the ELSS funds that are available in our industry today are diversified equity mutual funds. What matters, of course, is the process what each of these fund houses are following. So most of the time when I talk to investors, mostly young investors, the first thing that they would probably notice is what kind of returns these funds have given in the last 2, 3, 4 years. And we often forget that it's not just merely about what kind of returns you're getting over a shorter period of time, but I think it's also equally important to understand, what is the kind of process these fund management companies or these AMCs are following to maintain and to manage these funds. I think that's one bit that one should know. That's one thing that I would want to highlight, apart from just looking at returns. And also, if you are, looking at traditional instruments, like I had also previously said, that it's a good idea to combine maybe a traditional financial instrument, which would add more stability to your overall portfolio, and look at, having an ELSS kind of a product as well, which helps you, take the potential, which has the potential to give you returns from the equity markets. From my personal point of view, if I tell you about my portfolio, I have a good combination of PF and ELSS. A simple formula, and I think that's a good one that is very convenient and giving me good returns as well.
Prashant, a question for you. Motilal Oswal is going big with passive investing and index funds. So why are there no ELSS-based index funds?
That's something to do with how SEBI classifies schemes. So they have set categories. So there is equity, there is debt, there is hybrid, there is solutions, and then there is others category. So passive funds sit in others category. In equity, you have the ELSS get categorized part of equity. So nothing stops an AMC from managing the ELSS scheme like an index scheme, but to launch an ELSS scheme as an index fund, that will need to go back to SEBI and taking a separate one, because per se how they classify it, these are different slots.
Thanks. Sumana, you do a lot of education and training right? So where do you feel is the biggest hitch for young investors to get into ELSS investing, right? What do you think stops them, or what is it that, I know you said they talk about returns, but other than returns, where is there something that is a source of hesitation, and what is it that we can tell young investors to think about with regards to ELSS?
Right. So, Jaideep, most of the time that I interact with the millennials or the younger audience, one thing that often they tell them that, they get to hear about the traditional products or the traditional financial instruments from their parents, and they want to stick to their platform, and they want to stick to that known platform. So probably it's a fear of unknown that sometimes stops people or stops investor from exploring. And also this affinity towards following a fixed kind of a return. Like I said, I think those fears and those kind of those reservations one can overcome if you have a combination, like I said, a combination of a stable and a growth oriented product. That's one thing that people can follow. And otherwise, Jaideep, most of the millennial audiences that I interact with, they're very aggressive, and I think most of them are also liking the fact that they can go ahead, do a proper financial plan and add ELSs in their overall financial plan, and not just look at it only for the last 3 months of the year. I think that's one message that I really want to give all of you. Don't wait for the last 3 months of the financial year. Start your ELSS journey, your tax saving journey right from April of the financial year.
Right. Can I add one thing here? So Sumana mentioned this point about being fixated with a fixed coupon payment. So that is true. Traditionally, we had a fixed interest rate structure in India, especially small swing schemes and government scheme. But that has been changing. So last 2 years, if you see, though even those have become market determined. Of course, because of government, it is measured, it is gradual. But the fact remains that there is no escaping market determined returns now going forward. All these schemes are linked to a particular benchmark, and returns keep changing based on that. So that ideation or fixation of getting a fixed coupon, I think people should start learning to live with market determined returns. And if they do that, ELSS comes into play.
So I think that for the younger investors that's there, but I think for some of the older investors, the whole ELSS versus PPF comes into is always a big discussion, right? And they're more used to putting money in PPF, and for them getting into ELSS is very risky compared to PPF. So what is it that Prashant, what is it that you would like to, a message that you would like to give them?
PPF, of course, has its advantages. Those who are not into regular salaried kind of profession, for them PPF used to be kind of their retirement corpus saving. That was before NPS came into the picture. PPF was the only sole thing which they could utilize for their retirement thing. Now that NPS is there, they have an option. And even a much better option. Again, as I said, PPF, again, market determined. What rate used to be offered some time back, we are now at 7%. Of course, it's EEE, but if you look at it, 10% equity taxation, all you need is a 8 point some, just sub calculation. Yeah, so approximately about 8 point some percent return, so which you can get from equity at 90% probability over 7 years time period. PPF is 15 years horizon. Let's just take half of it, 7 years. At 7 years, you will get a net of tax, better tax returns than PPF with a 90% probability. Now, I think you should learn to live with 10% uncertainty.
Okay, last question to both of you. Sumana, you first. Any expectations for investors in mutual funds from the budget tomorrow?
I'm a firm believer of good principles of investing. And no matter what the budget is all about, I'm going to be sticking to my financial plan that I had made for myself. I don't believe in short-term insights and short-term tips. And that's what I want to give the same message to the younger and the older audience. Stick to good principles of investing. Do your risk profiling before you start doing your investments. And events like budget or any other political or socioeconomic changes, these things keep on happening. we go on and we see funds performing well. So stick to your investments. Don't get overwhelmed by short-term insights or short-term happenings.
Prashant?
So I will say, see, equity, there is no escaping equity. If you're not close to your retirement, there is no escaping equity. That's the new reality. Earlier you learn to live with it, better it is. Of course, you have to have a long-term horizon, and a disciplined way of investing can make your equity experience a much better experience, net of tax also, and as per your investment experience also. Earlier the better.
All right. Thank you so much, Sumana and Prashant, for being part of this panel. Very insightful, a lot of things I learned too, and a lot of great takeaways from our session today for our viewers. Thank you so much.
Thank you.
Thank you.
When investors typically come to Glide and ask for guidance, right, on how to invest and where to go next and what to do next, our first recommendations are typically to set up an emergency fund, followed by taking care of their taxes. But what next? What after they have done both of these? So to talk more about this, I'd like to introduce you to Harshvardhan Khona from the Glide Invest research team. Harsh came from an engineering background, got an MBA in finance, joined Motilal Oswal as a management trainee, and subsequently moved to Glide. He's responsible for research and strategy at Glide, especially for the portfolios that we present on our platform to our investors. These portfolios are available to investors through the avenue of goals. So let's dive right into what Harsh has to share with us about the journey from basics of investing to smart investing. Over to you, Harsh.
Hi. So now that you know how to invest the 1.5 lakh that you have to save tax, what about the rest? Most of us, when we were young, would just YOLO it into the next phone or the Goa trip. But as you grow, as your income increases, basically you realize that there is plenty of scope to invest. And instead of just doing the basic thing, let me present to you how to make it a little better, and more efficient. Yeah. All right. So human beings have always loved to hunt, right? From, say, our ancestors hunting prey in the plains of Africa to us hunting for parking space in the streets of a city. It's what we have done always. It's what we do. We are at our best when we are actually hunting something. And in today's parlance, it can be, say, chasing a goal. So to do that, randomness is often something that breeds inefficiency, whereas targets bring focus, they bring efficiency into our output. The transition of this thought process to make it more target oriented, to make it more goal oriented, is what it takes to bring your investment performance to the next level. Like all transitions involved, the action is grounded in 3 questions: why, where, how. And today, through this webinar, that's what we aim to help you answer. So why invest? Inflation is a silent value killer. In money today is not the same. Value of money today is not the same as value of money tomorrow. Reduction in value of money tends to have a negative impact. It escalates, it compounds as you grow, as you move forward decades into decades. A 10 rupee dairy milk today is nothing as compared to the 10 rupee dairy milk we used to get at that time. So normally your income grows as well, but once you retire, that stops, and the expenses, as we can see, are going to be really inflated. So second part of it is a corollary to that. So as you grow old, your healthcare experiences also increase. As we age, our body's wear and tear is increasing further and further. So let me give you my example. Just 10 years ago, I could have had a party till late 3 in the night, had a beer at 4, woken up at 6, gone to the gym, and would have been like nothing. Today, I have to sleep by 10, otherwise I'm screwed next day. So increasing healthcare expenses are part of it, and without an income or without some wealth, some investment backup, that also is something that will be challenging for you to meet. Third is the lifestyle creep. This is something we all of us experience, but we don't actually acknowledge it when it happens. So as your income goes up, your expenses go up as well. It's more in terms of you want to have a larger house, a larger car, better electronics, international travel, preference of brands. But what happens here is, as with inflation, as with say healthcare expenses, this tend to hit you suddenly when your income stops. The biggest proof of this you will find on LinkedIn when it was during the pandemic, when it was flooded with people with decades of experiences having lost their jobs, but with no financial backup, struggling to make ends meet. So that's these three elements in all tend to classify everything that we need to do on why we need to invest. We need to invest so that we can keep these three prongs of a trident at bay. So now that we know why to invest, let's look at where to invest. So there are several things that are going on in the market. The financial markets have matured significantly. We have stocks, we have fixed deposits, we have a lot of other cryptos and NFTs as we speak. Crypto faces uncertainty, NFTs are rampaging apes. But then, anyways, where I come to invest, there are four asset classes that we look at that are easily accessible to all of us, that we can actually go on a website and log in and click it instantly, and it's regulated and it protects us. And those are the ones that we at Glide tend to look at. The first asset class is equity. It has beaten inflation 100% of the time. Potential wealth generator. Of course, there are downside risks to it. It's volatile in nature. It's unpredictable. You will lose money, but where won't you? So equities are a must in a portfolio, especially for young investors. It is a long-term wealth creator for certain proven over a century of track record as well. Fixed income is something that as a young investor forms a small portion of your portfolio, but is very essential when you move towards your retirement. It is a stable element in a portfolio. It's called a fixed income because you have a fixed rate of return and you know what you're going to get periodically, regularly, and with dependable consistency. Returns are of course lower. Consistency comes at a cost, and uncertainty comes at a reward. So risks are often lower, returns are also often lower, but you need to have them as a part of your portfolio so as to have a calming influence on the same. Gold, of course, our mothers, our ancestors have gold since never. They've used earlier we used to bury the gold in our ancestral houses. Now we bury them in our safe. So gold is a timeless, ageless asset. We need them. It's often a flight to safety during crisis. Moves quite opposite to equities most of the time. Used as an inflation hedge. So it's a pretty good asset to have, more specifically during crisis. But as a general, but because you can't predict a crisis or you can't know when it happens, it's better to have some exposure to gold in a portfolio so as to mitigate aspects of crisis. And finally, cash. Cash is an emergency use asset. It's not something that has to form a significant part of your portfolio, but it has a direct and easy convertibility to other asset classes. So what you can do is anytime you get an opportunity, you have cash in a portfolio which you can deploy. That makes cash a really useful part of your portfolio, but a minimal part of your portfolio. So now that we know where we have to invest, why we have to invest, the final riddle is how to invest, how to get that thing smart. So key to it is asset allocation. So there is historically there has been no single asset class that has done well year on year. We always have some years where equities do well, some years where real estate does well. There's even a year where cash has done well. It's 2018. So the best solution to this is a mixture of asset classes that help you create a all-weather portfolio so that you don't have to look at it every year. And you can't guess, right? You can't guess which asset class will do well which year. So it's you can't. It's no one can actually do it with consistency. So it's better to have a mix of asset classes that tend to have properties that help balance each other's bad stuff out and get you a very stable quality portfolio. True diversification always occurs when your investment is spread out across asset class and not only in a single asset class. So generally diversification, as we are taught, is all about investing in various stocks, or even in, say, fixed income. You invest in some FD, you invest in some government securities, but if that asset class tax, you are screwed. So you can't, what if the markets fall suddenly tomorrow? No stock diversification is gonna help you, but an asset class diversification will help mitigate some aspects of that element. So for those of us who invested, say, in December of 2019, is what we face the scenario. So Goldman Sachs did a study. Through that study, what they showed was that for your entire investment return, 91.5% of that return is attributed to just asset allocation. Everything else is a very small portion. No matter how good you are at market timing or at security selection, asset allocation is what contributes 91.5% of the return. Wealth is created in the long run, and to do that, investors need to have an ability to hold through various market cycles. So that is something that we at Glide have a conviction on, and that is something that we would like to show you at this moment. So if you were in 2019 and you were December 2019 and had you invested in say equity, 2 months later you would have seen a devastating crash. But because, say, other asset classes tend to have, say, for example, gold tends to have an opposite movement. You see gold moving up when the markets are moving down. So now imagine if you had that in your portfolio, if you had, say, some element of gold in a portfolio, the panic would have been avoided. You would have avoided a panic that tends to grip you in the initial stages of the crash. So what we did was, we had a portfolio, we have demonstrated one with gold. And what you see is that portfolio, a 50-50 portfolio of gold and Nifty 500 will actually remain flat. It remains stable. It even appreciates a little. That panic that grips you only in the initial portion of that thing, after which you tend to calm down, you tend to evaluate various scenarios, and then you realize that maybe it's not bad, maybe I'll continue investing. To prevent that initial panic, you need to have a right mix of asset allocation that ensures that you stay invested through. For investors who manage to stay invested in this period, earned significant returns. Markets are nearly doubled from that point onwards. Such phenomenal returns would have only been possible had you been invested in that. And that's what is our conviction, that an efficient asset allocation portfolio does for you. And that's what we have implemented in Glide's asset allocation portfolios. We have put this conviction into action, creating and implementing portfolios for our users that help them weather this stormy markets, help them stay invested for the long term, and that's when wealth creation actually occurs. So efficiency is the key point in our portfolio. We have used Nobel Prize winning economist Mr. Harry Markowitz's modern portfolio theory. We have put it into action using Goldman Sachs Black Litterman model. What we have done is we have minimized your risk for the same amount of return expectation that you need. So technically you are getting more bang for your buck because you're taking a relatively lesser risk than a general standard portfolio. And our policy is to be in passive. Passive is a long-term, passive space has been a long-term wealth creator. No one can consistently beat markets year on year, every year, and you can never predict who's gonna do it, who's not. Even you can't predict what the market is gonna do next. So passive is something that has always consistently delivered the return. There's no risk of underperformance, and there is no one to make active fund decisions. The costs are also very low, and that's why we have ensured that our portfolios are all into passive. How we do is we shortlist the asset class that we want to present. Then we determine the risk profile of our investment horizon. We shortlist a passive option in each asset class, create an efficient portfolio using the Black Litterman and Markowitz model combo. So investor simply has to finalize a goal and make one single investment. We will do the rest. We also have incorporated timely and tax efficient rebalances so that we can maintain the efficiency of the portfolio going forward. Proof is in the pudding. This is a sample of one portfolio. What we have done is we have delivered outperformance over our standard equity index portfolio, but at almost half the risk. And that ensures that when the markets fall, you fall less. That allows you to stay put. It is within your tolerance, it is within your limit, and you can continue investing so that when the markets recover, you are actually much better off than had you panicked and sold off at the bottom. Invest with a goal, we will take care of the rest. That's what the aim is. So as I said, we are better when we are actually hunting. We are better when we actually focus. We will help you do that focusing part. You will just have to come and work with us. We will do the rest. A diversified and efficient portfolio is something that allows one to stay invested. Most investors often lose because as I said, they are shaken out. So Glide portfolios are designed to not only maintain that stability, but also capture volatility and during that rebalancing. That's I guess it from my side. There is a lot of stuff in detail available on our website and on our blogs. We are also available via easy contact us options that are there. Please reach out to us if there is anything, any query, any doubts regarding how we have done it, and we'll be happy to help you out with that. Thank you.
Fantastic session, Harsh, and thanks so much for sharing all this information. Really, again, a lot of knowledge sharing here, and we hope more knowledge sessions with you in the future. So we are out of time today, but I'll quickly answer 2 questions that our viewers have asked on YouTube. So one of the viewers have asked, the income from ELSS funds is tax-free. Is it tax-free? So the question should actually be, are the profits from ELSS funds tax-free? Not income is never tax-free, profits are. The answer here is that no, the profits are not tax-free. However, if you remember what Sumana said, every year you get up to 1 lakh of tax-free benefits from the government for equity funds. So when you do sell your ELSS funds in the 3rd year, they already get into the long-term investing category. And as a result of that, the profits that you earn from selling those units or those funds may be tax-free, provided you don't cross that 1 lakh limit. Another question that one of our viewers has is, can you increase the SIP amount every year for ELSS funds, or will it be a fixed SIP amount for 3 years? Again, the answer to that, I would say, is yes, you can increase the SIP amount of an ELSS fund every year. You treat it just like any other mutual fund. However, your ATC deduction benefit is only to a limit of 1.5 lakhs. So if you increase the ELSS fund and if it crosses the 1.5 lakhs, you won't get the additional benefit just by increasing the SIP value, right? The benefit is fixed to 1.5 lakhs. So that is it. So once again, thank you so much for taking out the time today for attending our webinar. I'd like to thank both the DSP and the Motilal Oswal teams for partnering with us on the same. So at Glide Invest, we hope to handhold our customers through and guide them in the complex world of investing, making it easy and stress-free. From DIY investors to goal-based investors, we believe that retail investors across India are inundated with information today and need some guidance on making the right investment choices. And as the famous professor from Harvard University, Clayton Christensen, would tell us today, our vision at Glide Invest is to do the job of being an investment guide for our customers. Thank you so much and good evening.
Thank you.